Guys, the PMI numbers came out this morning. Not so great. We're going to talk about the declining numbers and what that means for you. So let's dive in.
Trade Genius.
All right, Bob. So, the PMI numbers came in and worst numbers that we've seen in a while, basically rivaling the stuff that we've seen at the COVID crash and also going into the great financial crisis. And I think that puts us in an interesting situation here with as far as like what the Fed is looking at and how they're going to react going forward.
Yeah, and also Phil too, with this PMI number doing what it's doing, is that the stock market's also flirting around with this 200-day moving average, and it's it's like 16 or 17 times it's done this cross this year. It's only done that two other times too, in 2008 and 1929. So we're kind of in some really weird territory here, where the market is either the big money is trying to create an environment where they can exit, or we're just going to dump here. And
Right.
so, it's really kind of scary to me. But the weird thing about this whole thing, Phil, is not that PMI is falling. I think we can all expect that. Hey, Phil, why don't you throw up the detail behind that? There's a chart that shows kind of a little bit more detail here. So what's really happening here, guys, is that employment is falling, manufacturing is falling, but wages are rising. And this is, there's a term for this. It's called stagflation. And stagflation happened in the 70s. The only other time we've had stagflation, as far as I remember, and it's ironic about stagflation, it's coming during the currency crisis. So we have an issue here where, it looks like the end of the fiat regime around the world, and basically the money lenders and the fiat creators have reached the edge of their ability to create economic growth. So all we have now is rising prices, rising wages, and falling economic activity, and that's stagflation. And I think, Phil, you want to talk to the leading economic indicator thing, because that's also showing us flashing some warning signs too.
Yeah, if you guys see this chart here, basically you want to pay attention to where that red circle is and look at where that reading is compared to the other times it's gotten down to those levels. And it's coincides with the 2020 recession, the 2008 recession, the 2001 recession, and so on and so forth. So it's a very recessionary reading. And if you're not familiar with what the leading indicator index is, it's essentially a basket of economic data. It looks at the stock market, it looks at treasuries, it looks at consumer spending habits, it looks at manufacturing output and manufacturing costs. So it's a very detailed basket of things. And it's not just looking at one little section of our economy, it's looking at basically the entire thing, and very accurate in terms of forecasting a recession. So that's what the leading indicator is. Bob, you showed me a chart I thought was interesting in that the leading indicator, this is basically this orange chart, or this orange line is on this next chart here. That orange line is that blue line, and then the red line is what's basically where they're cranking up rates. Talk about them raising rates 50 basis points, 75 basis points. That makes that red line go up. And Bob, there's something interesting about this chart you brought up.
Yeah, I mean, look, they don't raise as it's falling.
Right.
And because they're very, very, very afraid of stagflation. And look, last time it happened, it was, in the 70s. So we're repeating a cycle here. So I think the Fed's very scared. And they're using their old playbook. They got a hammer out, and they're trying to hammer down a nail that doesn't seem to want it. It's stuck in a knot, and they can't break it down. But what they're going to do is they're going to destroy the economy before they're able to get wages down. Because of demographics, Phil, there's just not enough workers, and they have to pay them. In fact, 2 minutes before we got on to do this podcast, one of our subscribers just flashed that Walmart across the board raising average wages up to $17.50 an hour. We're going from what's called a pull inflation environment to a push inflation environment. And when that happens, people have money to spend, and they're going to be chasing fewer goods, and you're going to have inflation. And it's the kind of inflation that the Fed hates. So that's kind of what I want to share on that, Phil.
Yeah, next week, guys, we're going to go into that a little bit more as we head into the FOMC announcement on the 1st of February. We're going to dive into why, it's everyone's thinking Fed pivot, but we're going to show you that if wages are outpacing inflation or staying on par with inflation, then the Fed has a lot of work left to do. And don't be surprised if they they actually change the narrative from, say, Fed funds rate of 5% to 5.25%, that they start maybe lifting that more, because until they start seeing the market react, which, we're at 4,000 plus in the stock market, that hasn't been, a huge reduction, especially when you're trying to fight inflation. So I think when they're saying we got a long ways to go to fight inflation and we need to see a sustained move down in inflation, they're not joking. And I actually think that they are correct for once about something, in that it is going to be a hard fight. And I think people are a little too quick to look for the Fed to pivot and start either pausing or cutting rates too soon.
Yeah, and the ironic thing about it is, we're talking here earlier in the week, we think the rest of this week can go higher, in the market, but we're really trying to help you guys understand the bigger picture here. If you're moving bigger money around, 3 or 4 days lifting it into the Fed meeting is nothing compared to getting this thing goofy footed for a 2 or 3 month decline in the markets. And that's what we're most concerned with. We have the biggest disconnect between narrative and what the Fed's going to do, as we did in August.
Right.
And just remember what happened to the market after August. So that's what's happening now. And I think Powell is very, very concerned that people are not listening to him, or they're not taking them seriously. And the other thing too is, and maybe we'll do this tomorrow, let's talk about how the Fed's actually causing some of their own problem. And we'll explain that to you tomorrow. But at the bottom line, all these mistakes and his intentions are going to come back on us. It's going to cause a very, very, very sharp recession at some point, and it's not going to be pleasant.
No, I agree. So anyway, stay tuned for that, guys. And thank you for watching today. Please hit like and subscribe. Really helps us out. And we'll see you on the next episode. Take care.
Trade Genius.